G'day and welcome to this week's video. My name is Ashley Rowan and I'm a financial advisor with Consortium Private Wealth. Today's video we're going to be exploring two different strategies and comparing the two to see which strategy would have the best benefit for our clients. Now these include contributing surplus funds in towards your home loan versus contributing those same funds into superannuation by means of salary sacrifice. Now in today's marketplace we're experiencing record low interest rates, so with a regular mortgage at the moment it's sitting around 3% per annum. Many investors are considering their options whether to contribute those surplus funds elsewhere or invest, knowing that if they do contribute those funds into the mortgage, they're saving that 3% interest charge. Now, as an alternative, and what we've been exploring for our clients is contributing those same funds into superannuation by salary sacrificing. And salary sacrificing essentially means contributing pre-tax income into super in preference to receiving that as just regular income. Now, to highlight the benefits of this strategy, we'll use a case study, and we have a chap called Philip who is in his 50s. Now, Philip earns $120,000 per annum, and he has his savings capacity of $8,000 per annum, or roughly $666 per month. Now, Philip's marginal tax rate is 37% plus 2% Medicare levy, so that gives him a total tax rate of 39%. Now, in Philip's situation, he has a outstanding mortgage of $350,000, and he has a rate of 3% per annum with his bank. Now, Philip has 20 years left on his loan, and in his 50s at the moment, he'll carry that debt right through into retirement. Given that he's only paying his just basic principal and interest, that equates to just over $1,900 per month. Now, for Philip to contribute an additional $8,000 per annum into his home loan, he would have already paid tax at a rate of 39%. So, for example, his pre-tax salary, he would need to have paid $13,114, taxed at 39%, and the net amount that he would receive in his bank account is $8,000, which he will then use to pay down the mortgage. Now, if he decided to salary sacrifice that amount, his equivalent pre-tax contribution, so back to that $13,114 amount, he could use pre-tax money to make that full contribution into superannuation and only pay 15% tax as a concessional contribution tax. So his net contribution in this instance is $11,147. So the real benefit of this strategy comes about from comparing the two amounts he has to invest. His first $8,000 he's investing into his home loan to save interest, or with the equivalent amount of money, he can invest $11,147 into superannuation. So the first benefit here is the tax savings and the amount that Philip has to invest. Now, to work out how much benefit this strategy will be for Philip over the longer term, we've designed a calculator which I'm just loading up now, and this measures, as I mentioned, the long-term benefits of comparing the two scenarios. So let's input Philip's data here. We mentioned he had a loan outstanding of $350,000 and an annual interest rate, very conservative, of 3% per annum. He has 20 years remaining on his loan, and his extra monthly repayment, so we mentioned he could contribute $8,000 per year of surplus income. That works out to be $666.66 per month. His standard repayments are just over $1,900 per month. We know Philip's marginal tax rate is 39%, so we'll select that one there. And we'll say, just for the purposes of our projections, Philip achieves a conservative 6% investment return within superannuation until retirement, for example. Now, comparing those two scenarios, we look at the benefit in this column here of the home loan, and we could see after 13 years that by Philip contributing $8,000 extra into his principal and interest repayments, that he will be $127,000 better off. In comparison, if Philip were to invest that money into superannuation and then have compounding investment returns on top at a rate of 6% per annum, after 13 years, Philip's superannuation fund would be better off by $208,000 approximately. So when we can compare the two scenarios, the difference of the two after 13 years is Philip will be better off investing through superannuation, as you'll be better off by over $80,000. So comparing the two over the longer term, it makes a huge amount of difference. Now, if we have a look in, let's say 13 years and Philip was in his 50s, so at age 63, Philip decides to retire. The balance under normal principal and interest arrangements of his loan to pay out his $350,000 home loan in 13 years' time, that balance will be down to $146,000. So we could see that he would have accumulated over $208,000 in extra super investment, that at age 63 he could simply withdraw that amount and clear out his debt if that's what he decided to do. Additionally, over those 13 years he continued doing that strategy, he would have saved over $40,000 in tax. And that's the difference of that amount where he would have received that $8,000 as income and had paid tax on that, versus contributing that extra amount into superannuation and only paying 15% contributions tax. So there's quite a substantial tax saving there for Philip over the journey as well. So the two scenarios, while home loan rates are so low, there's definite benefit of considering other options, and in this case investing through superannuation and the compounding effect that regular contributions have on the balance of his account over the longer term. Thanks for watching. I hope the information was valuable, and just remember this is general information only. So I'd suggest speaking with a financial advisor if you think this could be a strategy that you would benefit from yourself. Thanks for watching.